Hi there everyone, Rob McGregor here and welcome to our end of August edition of On Track, coming to recording this on the 30th September. I'm a little late this month, it's been a big month on all sorts of fronts, but yeah, happy to get this out to you. Let's dive right in. General advice warning firstly, this video is designed for clients of McGregor Wealth Management. It may be interesting to other people, but before you act on anything here, you should get advice from your own advisor. So what we're going to cover in this month's episode, we're going to have a look at some important economic news. We're going to put it into context. I'm going to particularly have a look at where we are in terms of GDP and markets, where we're going, where we might be going. We're going to talk about, we've got a budget coming out next week in Australia, and government debt is about to rise massively over the next few years. We're going to talk about what that means and whether that's important, whether it's a good thing or a bad thing. We're going to talk again about the case for and against rising share markets, and as always, trying to put it in perspective as I take you through key updates. So the highlights, it's still, all the news is still massively dominated by COVID. We're seeing a mixture of what's happening around in the world. COVID's rife everywhere. The mixture is in the strategy, and you've got countries like Australia and New Zealand, or should I say states like Victoria and New Zealand, and others that are going for the lockdown every time there's an increase, to others who are managing it slightly differently. I'm not going to dwell a lot on what's happening with COVID. There's lots of news about that. There's COVID cases throughout the world. We've got this trade-off at the moment between opening up and managing COVID cases. We will come out of this eventually. There is more talk again of a travel bubble between Australia and New Zealand. We were almost there when the Victorian second wave broke out, so hopefully this time we're going to see that. And I think a lot of these states and countries are pretty aware that they need the tourism dollar, particularly countries like New Zealand, states like Queensland and Western Australia, although particularly Queensland and New Zealand that are net importers of tourists. We've got COVID vaccines being tested in different phases. We've got some of the more advanced ones in stage 3 testing, and a lot of the epidemiologists, a lot of the authorities in this are saying we probably have some early vaccines out towards the end of the year, early next year. The US has said get ready. They've told the states to get ready to be able to distribute testing from about November. I don't know how much of that is driven by the fact that that's around the election time, and whether that's wishful thinking, but it looks very promising for a vaccine early in 21. Now, how long that takes to get out will be critical to how quickly we get back to some sense of normality, but it's a big job. To vaccinate masses of population will literally take the best part of 6 to 18 months, depending on who you believe, but it's going to take a while. There are some people that won't get vaccinated for whatever reason, because they don't want to travel, or they're happy enough not to take the risk. So it's going to be fascinating to see what becomes compulsory. I don't think they'll make vaccines compulsory, but we may see things like countries insisting on people being vaccinated before they come to that country. We may see private schools insist on students being vaccinated. We might see other private workforces insist on people being vaccinated. So expect some controversy around that when it comes up. In the US, we've got the election race literally less than 5 weeks away. So literally 5 weeks as at yesterday, as I'm recording this. And it's getting closer, it's getting crazier, and it's getting to the pointy end. I make no prediction. All things are possible. There's a whole lot of stuff to go. I look forward to digesting the debates and everything else. I'm very interested in these things, but I really don't think it has much impact on the day-to-day stuff in terms of our markets and portfolios, this election result. I think there'll be some positives and negatives from both sides, depending on who gets up. The Republicans are generally considered a safer bet on the economy, but part of the world may consider the Democrats a safer bet on world trade, and things like that at the moment. Who can tell? Let's watch and see. As always, the media is focusing on the worst news it can find. It's interesting looking at leading economic indicators, in particularly the ones that forecast where the economy is going. There's a particular indicator called PMIs, and they're looking reasonable at the moment, and that's the Purchasing Managers Index, and that shows what businesses are buying, and that's a pretty good leading indicator. I'm going to have a look at GDP forecasts shortly. Any news on economic activity that has happened, so when they talk about what's happened in the June quarter, or in the next month, they'll be talking about what happened in the September quarter, it looks pretty bad. But it's very important not to get too focused on what's happened in the past. Markets are very forward-looking, so it's much more important to be looking at what's likely to happen. And as I said, we've got a big spend budget coming up in Australia next week. I'll be reporting on that to the Noosa Association of Independent Retirees. As part of that, we're hoping to record that, and I may get something out, a special edition on that, where we look at what it means, particular, I think we're going to get tax cuts, I think we're going to get big spending, and the last thing the politicians should be doing at the moment is cutting spending or raising taxes. We actually need to stimulate the economy. I'll touch more on that when I get to that segment. And as always, contemplating what happens next, the $1 trillion question. I've thrown some financial market figures there, particularly around rates on the side there. So you'll see the RBA cash rate as we speak, 0.25%. 90-day bank bills, 0.1%, so almost nothing. A 10-year government bond yield, if you bought a 10-year government bond, you would yield 0.78%, so 0.75%. The Aussie US is holding around in its long-term averages. It got up as high as 73. It's come back a little bit the last few weeks. The inflation figures, the annual inflation rate to the end of June is minus 0.3%. So that will mean no CPI pay rises for those where it's linked to CPI on an annual rate. But it means there is no inflation in the economy. That's partly why interest rates are so low, but partly because of the crisis that we find ourselves in. Mortgage rates are wide, but I sort of grabbed Commonwealth Bank type rates as a midpoint, 2.5%. You can find mortgage rates starting with a 1. I've seen some rates at 1.98, 1.9. I expect we may see some more of those coming up. And certainly we're seeing fixed mortgage rates in the low 2s over 2 and 3 years in particular. 1 year term deposit rates, the headline rate for the big banks is 0.7. You can chase around to some of the regional banks or some of the more lesser known banks, and you might get up to about 1.1, but still pretty bleak. Someone with $1 million in the bank gets $10,000 a year of interest. Someone who's spent all their money and has no money, or a couple who spent all their money, gets $37,000 from the government. So fascinating contrast, and that's going to cause people to chase returns, which is going to cause money to go into the share market. So let's jump into, and I thought I'd once again do a quick summary of returns up front, just for those that like hearing the summary at the start. But effectively returns, when we look at the 1 year returns, across all things, we're kind of flat to slightly negative. This was at the end of August. The market's dropped a bit since then in September, although it's coming back a bit as I record this. The portfolios, when I look at 5 year returns, which are critical, they are tracking reasonably close to those long-term targets that we use for your planning, which is very heartening considering we've just been through this crisis. And you'll see some highlights. The active portfolios held up extremely well over the last year with positive results, and the reserves portfolio has done its job beautifully as well. So all portfolios have done true to label, so the ones that are more heavily share market are down more, but we haven't done a lot of damage. And in doing reviews with our clients, we've seen most clients flat or slightly down over the period that we've had, and most of us are spending less during that period as well. Here's the contrast over the last 12 months, and you'll see up the top left here the scale. So VAS is the Australian shares, IOO is the top 100 companies in the world. But let me talk about the chart from the top down. 20%, that's gold. So in the last year, an investment in gold is 20%. That's in the active portfolio. The blue line is IOO, that's the top 100 companies in the world. It's actually up 6%. An investment in US shares is up 4%, and that's for us here in Australia. and the emerging markets are up 0.7%, but then we've got Australian shares and US small caps down 12 and 16% respectively. This once again tells us the reason we need diversification. So we're not hit or miss. We're not all or nothing on these things. You'll get a good diversified result. Just that framework again. We talk about the market going through those three stages: the boom, the bust, the boring, or the FOMO, fear of missing out, the fear, and the wall of worry. All major downturns till this one, and when I say major downturns of more than 20% have been preceded by major booms. This downturn was not part of that normal cycle that swings between fear and greed or fear and FOMO, but it was the result of a health crisis, and the first one certainly that we've seen that's had that impact on markets. But it's also why it's bounced back quicker than people thought as well. You can't compare this to a GFC, a 1987, a Great Depression, where those market crashes were in response to the market getting just a little bit too hot. This one was the fifth biggest in our history, so put into context, from reviews at the moment, we're talking about flat portfolios. That's not too bad. The recovery's been pretty quick, and certainly quicker than most of the other ones. I'm not going to dwell on this, but just that reminder. So much diversification in our portfolios, so much science, so much strategy underneath the bonnet, which provides that smoothing and, more importantly, consistent long-term returns that enable us to plan. What I'm going to spend time today on is once again trying to get away from that short-term focus. As a reminder, the mess it up is just an acronym for the ways people mess up their investing, and the media has just been horrendous to watch during this. I'm watching the US election with disdain, watching the media fall into two camps. So the media's become a cheer squad, either from one side or the other over there. I'm finding the best media coverage comes from not even in the US, but the BBC News, who has no bias, at least that I can sort of see, or has the least bias that I can see. So I'm focusing a lot on the BBC News. I do have a look at some of the right-wing media, Fox, etc., and occasionally the left-wing, CNN, just to see that sheer bias. But I must admit, I'm trying to look for more neutral sources to actually get a picture of what happens, because you've pretty much got that left-wing media that think Trump is the devil. You got the right-wing media that thinks he's the Messiah. The reality is somewhere in the middle, and I'm not going to go into it too much, except to say, we're going to have a close election. Really, really be careful about what you're reading or watching, because and consider the source. If you're watching CNN or a left-wing media, it's going to be more anti-Trump, and it's going to create a picture that he's more likely to lose. And the same when you're watching Fox or some of the other right-wing media, you'll get a different impression. So very important to try and get some balance. Let's have a look at GDP. So GDP is the global. It's the total of everything produced in Australia. So it's the health of the economy, and we'll see GDP growth normally in this left-hand chart. Normally has been spitting along between sort of 1.5% and 3% in Australia, and it's kind of boring in the long run. And you'll see on the top right-hand corner, GDP and constant prices just rising. But then we've had this hit of about down 6%, which is 6% drop in total earnings or total production. So once again, I liken that to someone who was earning 100,000. They'd been getting slow and steady pay rise, but all of a sudden there's a pay cut of $6,000. That's what's happened to the whole economy in Australia. And the point I want to make today is, if you look at where it's dropped and you go back, we've dropped back to about 2017 levels. So we've given up the gains of 2019 and 18, and we've dropped back to 2017 levels. So it's interesting to say, okay, what's the share market done? Well, the share market was up at around 7,200. That's the ASX 200. It dropped, it recovered, and it's back to about 2017 levels. So it seems reasonably logical, and this is part of our logic in assessing that the market is at fair value. In other words, it's responded to what's happened, but more importantly, the market, we should be forward-looking from now. So we feel like the market's at fair value, but let's have a look at forecasts. So on the left-hand side is the forecast also from our friends at Trading Economics, who rely on the Australian Bureau of Statistics. And you can see they're forecasting that turnaround, so back to growth. The top right-hand chart is from the IMF, which shows economies returning back to normal sort of growth pretty quickly and back to the pre-COVID levels somewhere in potentially 2022, with a great degree of caution about how accurate that is. So if the economy got back to its normal levels somewhere in 2022, would it make sense that the share market was back to its pre-COVID levels at that stage? And my logical answer says, yeah, probably. Not definitely, but certainly highly likely. So from where we are today, the market's just below 6,000. So if it got back to 7,200, that's an extra 1,200 points to get it back there. More importantly, from today's values, that's an increase of 20%. So over the next couple of years, if we get back to normal, and that is our base case, you may see share market returns over the next 2 to 3 years total that 20%. Now, if that happens sooner, we might get returns total that sooner. And that ignores, by the way, what I call animal spirits. You hear people talk about bulls and bears, so bull markets and bear markets. Once markets start to rise, we tend to get an increase in those bullish animal spirits and people come rushing in. And the same is true on the negative, of course, and particularly as we've got low interest rates. And I'll talk about the balance of these things shortly. Now, with the budget looming, and some of you might be watching this about the same time as the budget's coming out, you're going to hear a lot about how government debt is going to go through the roof. Just be ready for it. Don't think that it's necessarily too bad. So what I've got on this slide shows what debt levels got to, and the absolute debt number is not as important as the percentage of GDP. In the same way that when you borrow to buy a house, it's the loan to valuation ratio. So this shows that Australia's current debt, and this is government debt as a percentage of GDP at around 45%. It's climbing, by the way. That's a historical figure. Let's look back at what it has been, and keep in mind society has evolved through this as well. So we saw it peak at well over 100% back post World War II, and that was because they had to rebuild the economy. So they spent a lot to rebuild. To fund that, they borrowed. We then had some of the most prosperous times in Australia's history in the 50s and 60s, and that allowed taxes to collect and pay back some of that debt, bring it back down into more steady levels. We've seen debts rise under both sides of politics in the last 10 years. They both blame each other, but they're both just as guilty. And I've studied this, as I present this to various groups over the last 20 years. There's no one party better or worse than the other. And we've crept up again. Part of this is due to an ageing population with rising pension costs, rising disability costs and other things, and part of it's due to the Australian population's expectation that there be more services, and you could argue part of it's due to government waste as well, and I would agree with that, but I'm not sure I'm pretty sure that's probably always been the case, and hopefully they can cut some of that out. But expect to see this government debt ratio jump more towards those post-World War II levels over the next few years. Now, the only upside on this is with government bond rates, as I said before, at about 0.7%, the interest on that debt will not be huge while interest rates are low. And the only thing that's going to drive interest rates up going forward is an increase in the economy, and that's going to lead to more taxes and other things as well, and hopefully the government repaying debt. So governments will be spending money. That's going to lead to a rise in government debt, and they may also be printing money, and the way they do that is by buying back government bonds. It's a whole other topic, but you're going to see the headlines there: government debt through the roof, or forecast to go through the roof. Forget about debts and deficits. That political debate will be gone. You will see the opposition in Australia hammer the government on the debt crisis, but they would be in exactly the same position. And I didn't actually mean to use the word crisis there, because it's an inevitable outcome of our political and economic system, and we actually want governments to spend, because we have or we're in the middle of a war. It's a weird war. It's not even close to the human casualty cost of the other wars we've seen. It does have a cost. We've just gone past 1 million deaths. A lot of those are people that would have normally died from flu, and I don't mean to be cold or cold-hearted on this sort of stuff, but statistically, a lot of these deaths are people that would have died from normal flu seasons, and this is a big thing. Make no mistake, history's going to look back on this as a major event. It's a pandemic, as we keep getting reminded, but in terms of compared to, say, World War II, where 48 million people died during that, and untold economic damage, it's a different event, but it's going to require the same post-war like spending, and we're going to see that. And hopefully governments get it right in how they spend it, and I'll be watching the budget very closely, and hopefully we see some good infrastructure spending that invests in Australia's future. Time will tell. Quick update on all the sectors. Aussie shares in the month of August were up 3%. They've given that back during the month of September, by the way, so we're still flat. We're flatlining at the moment, and I think the whole world's on edge watching a mixture of politicians and are we going to get a vaccine, are we not going to get a vaccine? We're going to have second and third waves. If we get a third wave, I'll pose this question as I record this. Victoria's looks like it's got its cases down, but everyone's still locked up. If they start to release that, if Dictator Dan lets them out of the house and we get a bit more spread, will he lock them down again? That's the big unknown and one of the potential drags. Other countries around the world are showing less appetite for those harsh lockdowns, and they're letting it go, but still with basic restrictions, not unlike we've got here in Queensland at the moment, which is restrictions on big crowds, continued, meant to be social distancing, sanitise, and all those things. But time will tell. But Aussie shares still providing solid returns. I've left in the presentation here the top 10 holdings in each of these exchange traded funds that are held as part of the portfolio, so you can see those. The 10-year chart I've shown in the bottom right hand corner of the slides that follow, and 10 years, it's been a rocky 10 years as always in the share market, but absolutely a positive 10 years. If you invested in Australian shares 10 years ago, you would have had a compound return of 7.6%, and in a low inflation world, that's a pretty good return. Now, US shares, and this of course is in Aussie dollars, so it's a different to the US investors themselves, but we're actually positive for the year here, 10.4%, up nearly 4% for the month, and 10-year return about 17%. A large part of that has been declining Australian dollar, not all of it, and the other part, very consistent, strong US share market. And as I talked about last month, that's been driven a lot by the tech giants, and you'll see them there again in that top 10 holding in the US index ETF, which is Apple, Microsoft, Amazon, Alphabet, which is Google, and Facebook. So the 5 big tech giants whose profits and whose revenues are up pretty substantially during this period of time, as we all spend more time online and on devices. So US small caps, it's a more similar story to the Australian market, down about 10% for the year, up slightly during the month of August, and it's bounding along sort of sideways as well. It's interesting when you look at the top 10 holdings in here. I don't think there's any companies there that I actually know, not in any detail. Actually, I may know Cogent, but it shows the sheer mass of companies within the US that drive all sorts of economic activity. The global leaders, top 100 companies in the world, and once again, sitting at the top of that are the big 5, Apple, Microsoft, Amazon, Facebook, Google, etc. Amazon now becoming nearly $1 trillion company, while Apple $1 trillion company, quite staggering. Some of these big companies are bigger than the economies of, say, Germany. Quite fascinating. So global leaders have had a spectacular year, quite amazing. In a year that we've had, and it's partly because of this big tech. There's also some big healthcare in here as well. There's also a lot of staples like Nestle, and we've seen in Australia, Woolies, Coles, and companies like that have had good figures that are up 30% on previous year, as we all spend more on the basics and less on things like travel. So IOO has been good to us. It's had a strong year, a strong decade as well, 13% over the last decade. And emerging markets, well, they had a tougher run at first. When you lift the bonnet on emerging markets, there's some big companies in places like China, Taiwan, South Korea, companies like Samsung, Alibaba, Tencent, which are like the Amazon and Amazon and Facebook of China. So some massive companies in these emerging markets. And we've seen them revert back pretty well, doing better than the Australian share market because of that giant tech. Once again, these are all reasons that increase the need to stay diversified. And gold, very glad we've had gold in the portfolio. It will continue to be a key part of the portfolio, particularly as we've got crazy times in all sorts of things. Gold tends to do the reverse of whatever the share markets do. Not always, but often it jumps. And you'll see it was down for the month of August while most share markets were up. It's spiked back up a little bit since then. Most of the gains in gold, as I pointed out last month, have happened in the last 15 months as uncertainties crept into the world. So it will continue to remain a key part of the portfolio. Very important to note, gold doesn't produce any income, so it's something that should never be too dominant in any portfolios, but it does provide important insurance. So let me walk through the case for rising share market, and followed by this, the case for caution. And I touched on this a few months ago. I thought I'd revalue it. I've only modified this slightly because I think we still stand in the same way. But low interest rates drove those first three. Low interest rates mean we should be willing to pay more for growth assets, both property and shares. When you can only get 1% or less on fixed income, then you start to look at 4% dividends in the share market. You're more likely to bid that up and pay up till that was even 3%. So yeah, if people are willing to accept 3% dividends and 4%, for instance, that's a 25% increase in the share market. So not saying that's going to happen, but as people start to lock in these low interest rates into their valuation models, there's massive upside potential there. Also, people chasing out of those term deposits, out of those bonds, and just chasing the high dividends of whether it's the banks or through exchange traded funds or listed investment companies or just broader funds. People know they need to switch to potentially growth assets, shares and property, just to get a higher yield. And low interest rates, to talk about those borrowing costs, we've looked at properties for some of our clients, particularly the younger clients, where property makes sense as a long-term investment, and at mortgages of mid-twos, there's it's cash flow positive pretty much for any property around the median value. So that's going to encourage borrowing. Part of that's good, that will help the economy. Part of that is a little bit scary because it sets us up for what might happen down the road when interest rates go up. But for the meantime, there's no sign of interest rates going up anytime soon. And the only time they'll go up is when the economy starts roaring away again. And that doesn't feel close, but it will happen. So I would urge caution, not to borrow crazily and to do your numbers. We certainly do numbers for people on borrowings at much higher cost than they currently are, even though we can't see those interest rates rising for a while. Human nature, we've seen throughout this, people are spending money. Yeah, it's harder to spend money on big overseas holidays, but I've watched people swap that out for home gyms, for local travel, for new caravans, for house renovations, yeah, for all sorts of things, helping kids. But we're seeing that money flow through the economy, which is a very good thing. That's keeping businesses going. We're seeing massive government stimulus, as I've talked about. We're going to see more of that in the budget. We've seen federal banks around the world. That's the RBA here in Australia and the Fed in the US. Print money. They don't physically print money, but they buy back their own bonds, which throws extra money into circulation. And that money that's thrown into circulation, most of it finds its way into the share market one way or the other. We're going to see all that stimulus is going to increase GDP. We've seen those forecasts, as I pointed out. So we will get GDP back to normal. That will bring share markets up as always, because private enterprise, which is the share market, will make a profit out of that increased economic activity. And that may lead into global rising commodity prices as we go through this rebuild. Think infrastructure projects, think China still growing strongly. That all has massive demand for things like our iron ore, but also other commodity prices. So we may be at the start of a new commodity cycle. And then we get these animal spirits. As all these numbers start to improve, confidence improves, and that pushes extra money in the share market. You'll know people, and I know people who've got money on the sideline waiting to see what happens, and ironically they end up paying more for their shares, but they do it because they wait and they do it with confidence. And the alternative at the moment, besides shares, and I'll throw property in here too. What else can you invest in? Money in the bank doesn't attract almost any return. Still highly important for liquidity and for all sorts of reasons, but next to no return. The negative case, the final economic damage is unknown. We don't know how long this is going to take to play out. At the GPS Investment Committee meeting this month, we had a presentation from some managers that look after airport assets, and their prediction was we won't get back to pre-COVID travel levels until 2026. So that's not when we can travel, but that's back with travel being at the same level as it was pre-COVID. Now they're being a touch conservative, but that causes a whole bunch of lost economic growth. Now people are spending elsewhere, as I said, but we don't know what this damage is because we don't know how this plays out until we get vaccine. So that time to recovery is unknown. Could it be 6 months? Could it be 18 months? Could it be 2 years? They're all possibilities. We don't know, but we will watch with caution. The COVID, we've put a lot of faith, particularly states and countries that have locked down have put a lot of faith in vaccination. If a vaccination didn't come, they've got massive issues because they can't open up. Massive issues. It's looking highly probable we're going to get a reasonably effective vaccine. There's no guarantees, but certainly a lot of the leading scientists are now predicting that, as I talked about earlier, in the next 6 to 12 months, maybe sooner. Initially, those vaccinations will go out to health workers and those in the most need. We will continue to see, it hasn't been talked about as much lately, but improvement in treatments. We've seen that with most illnesses over time, even for things like HIV, which is a virus where they haven't been able to find a cure, but they have treatments now which have lowered the death rates, although those death rates are still pretty staggering when you look at it. Travel is the big wild card. When will we be able to travel? We certainly are aware that people in Europe have a lot more freedom than we do at the moment in terms of travel. I was talking to a client in South Africa who's got similar sort of restrictions, but they're just starting to open up in Africa, but massively varied by country. So how we open up is going to be interesting. It's going to be directly linked to vaccines, and I suspect you're going to require a stamp in the passport to say you've had a COVID vaccination. I'm pretty sure I would do that, but I'll wait to see on all the testing results from the vaccine. But I'd be pretty keen to do some travel. But the masses, we've seen popularity rise for leaders who've gone hard with lockdowns. So that tells me the masses are scared on all this stuff, as they usually are, and with mass psychology. So that means they may return to travel slower, but they will return. On the flip side of that is I think we human beings have relatively short memories, which means, as this comes out of it, we'll be in a hurry to get off to some of our holidays, maybe. There's still a whole lot of tension around trade wars and currency. We've seen China flexing its muscles to Australia and reminding us we're just a little country economically, and if we dare talk too much bad stuff about China, they'll smack us around a bit. On the flip side of that, they need our iron ore desperately, and luckily for us, there's not too many sources of it. Brazil is a major source, but they struggle to provide consistent supply. But these things are a potential threat. And the other one is politicians going crazy. We're seeing an increase in adversary in many countries like the US, where people have just become so partisan on issues, they just cannot see the other side of any argument around politics. We've seen politicians enjoy their power a bit too much with shutdowns and other things. We're seeing, I won't dive into it too much, but all sorts of craziness. Part of me says this is kind of normal. This is why politicians get into politics. We do have some good politicians on both sides as well who come into it with with the right reasons. But yeah, that will remain a risk to the share market. And there's always what else might happen in the world. But generally, we believe, and I believe, we're at fair value in the markets. Now, all that means is it's a reasonable time to invest, where you have the normal probability, roughly 75% of upside, and the normal probability, roughly 25% of downside. I think the downside is probably limited due to where interest rates are, and that provides a break there. But you can never say never with the share market. And I think there's also some extra upside risk. That means if we come out of this better than we all think, we may see economy take off, share markets take off quicker than we think. And let's hope so. There's those performance numbers again. Main thing to note there is long-term plans on track. The reason we invest is for you to achieve your long-term goals, which are part of your plan. Now, before I wrap up, just the property numbers from our friends at CoreLogic. Some slight red ink in the month of August, but not very substantial. And that's swayed by people that have to sell. For most of us in times like this, we're going not selling. There's certainly pockets, both regional lifestyle areas around Australia, including places like from where I'm talking now, Noosa, that are doing quite well, where there's lots of activity. It's going to be fascinating to watch post-COVID, whether we get a change in Australia's migration patterns, both from overseas but also internally. Generally, about once a decade, you get a strong wave from the southern states into Queensland. We didn't have that massively in the last decade, which is why Brisbane prices didn't keep up with the same sort of growth rates that we saw in Sydney and Melbourne. But I suspect we may see some immigration from Victoria and Melbourne in particular, heading north for obvious reasons. There's got to be jobs, of course, and that sort of thing, so it won't be massive. But agents are already talking about how people are buying properties off the internet, people from Melbourne and other places, just so they've got a place in more friendly areas like Sunshine Coast, like Queensland, but also like regional areas of New South Wales that are all doing reasonably well at the moment. But no major impact on property. It's held up solid, and rents have held up reasonably solid. There's definitely cases of rental challenge, but rents have held up well, and in some areas vacancy rates have dropped right down because there's not a lot of development going on. And when you pull away development for a while, that leads to a lack of supply. So if you get population growth, that'll lead to a shortage, and that'll lead to price increases. So I think property in most reasonable places in Australia, there's some fair buying. Our friends at Heron Todd White updated property clock for what it's worth. And keep in mind, this can move quickly. We've seen them push Melbourne and Sydney all the way around the clock twice in the last couple of years. They've got Melbourne and Sydney are starting to decline. They've got suburbs like Darwin, cities and places like Darwin, Bundaberg at the bottom of the market. Doesn't mean they'll rise straight away as well. But we are seeing some, certainly in southeast Queensland and other parts of Queensland, we're seeing rising markets, hearing some good recovery stories out of places like Gladstone and Rockhampton. I tend to avoid those for our clients as investment locations because of the sheer volatility, but we're seeing some good recovery stories there. Sunshine Coast, as I mentioned, is doing well. Heron Todd White has it as approaching the peak. I don't necessarily agree with that, but I recognise my own bias and my own property holdings, although I do also own properties in Victoria. And units much the same. Let me wrap up, reinforcing our process and exciting life and boring money. Hopefully you're all getting on with an exciting life within the restrictions that we have, wherever you are. Our money's been not quite as boring as we'd like this year, but certainly it's held up amazingly well given what's happened. And that's because we put together these portfolios to serve a purpose, which is to meet your plan, and that's based on your goals about what you need in retirement. All investing is best done as part of a plan. Portfolio is designed to meet that plan, and we do take a long-term view. Once we get rid of the potential for people to make bad decisions, we then get down to the boring stuff that makes for good long-term returns that aren't too volatile, which is diversification, asset allocation, and enough liquidity to ride through the downturns, and a low-cost approach for most, which enables us to capture most of the return and not see it go to excessive fees. And that short-term volatility we protect through having enough reserves for our retired clients, and dollar cost averaging the market for our clients that are still building their wealth. And rebalance regularly, boring but adds value and pays for fees. And I always like to finish with the only 3 ways to really lose money on the share market, and as always to say, don't do them, but panic and sell, obviously have to sell, and not properly diversified. For you who are properly diversified and who have enough liquidity to ride through a crisis, and who are well advised and well educated and don't panic and sell, you will reap the benefits of long-term investing, and that will deliver the plans. Thank you very much for listening. I know I've had great feedback from many of you. I appreciate that, and we appreciate that. It's part of us helping to keep you up to date, informed, so you can focus on your exciting life. And with these occasional updates on what's happening with the money. Till I see you next time, Rob McGregor signing off.